Welcome back. This represents part two of the income statement lecture series. And if you recall, now we're going to be working from the below the line items. Now, this is all new information, so it's definitely something we're going to cover in depth. But one of the new pieces that comes in below the line, below the tax line, if you remember, are discontinued operations. Now, discontinued operations are defined by criteria that were updated as of the first quarter of 2015. And they have two criteria that have to be met in order for something to be considered a discontinued operation. The first is that the results of the operations and the cash flows of a component of a company have been or will be eliminated from ongoing operations. So this sort of suggests really two things. The operations and the cash flows are going to be eliminated, but that means that they also have to be separable from the ongoing company. So they have to have a sort of independence from the operations we plan on continuing in the future. So separable from the ongoing portion of operations. So you have to have a separate a sort of operating management team, a separate cash flow recording. You have to know how to separate the two. You have to know what expenses are going to be associated with the discontinued operation, what revenues are associated with the discontinued operation, because without that information, we couldn't separate this section, this discontinued operation, from the stuff that occurred above the line. And so that's a really important distinction for us to be able to understand. The second is that the discontinuation has to be a strategic shift in the company's continuing operations. So maybe a different focus in geographic area, different lines of business, or perhaps a very significant equity investment that is being sold off. So for example, I mentioned the Sports Authority thing just because I keep seeing all these going out of business sales, but that's not a discontinued operation. Sports Authority will still continue to offer sporting goods in roughly the same geographic areas that it used to. All it is doing is streamlining its stores and closing many of them down. Again, that's a restructuring cost, which is distinct from discontinued operations. So looking at these examples, the first example, the multinational silver mining company sells a foreign subsidiary mines in South America. The company has many other mines in South America and continues to operate. And this would not meet the criteria for a discontinued operation because it still has many other mines in South America. So this does not represent a strategic shift. If they were an American company selling off all their South American companies, all their South American mines, then yes, that might be a strategic shift. Best Buy agrees to sell its Geek Squad division, ceasing its service provision and investing more into its retail sales division. Yes, right? The Geek Squad is really a strategic shift because that is a service that is offered by Best Buy, whereas the rest of Best Buy really is just a retail chain that offers consumers goods rather than services. Comida is a food conglomerate that disposes of one of its two major subsidiaries. One presents a supply chain investment, selling food wholesale to supermarkets. The other subsidiary sells food through its network of franchise restaurants. So this one's a little bit finer of a distinction. Some of you might say yes. Some of you may say, no, this is not a discontinued operation because it's still food. But really, we are shifting our operations. Rather than being a supply chain that sells food wholesale, we're working through a network of franchise restaurants or vice versa, right? So the idea of selling food through a restaurant involves a totally different set of expenses, operations, than does just supplying food to supermarkets and delivering it to a grocery store, for example, right? So I think that, yes, this does. And again, it's important to note that this is professional judgment. There will be some decisions that the auditor will wrestle with that there won't always be a clear-cut answer to these things, and that's accounting. There's gray area, or else there wouldn't be scandals, and there wouldn't be practices that continue for many years until they're finally caught or questioned. So let's look at how we present this more technically. This is, of course, what it is. Now we're moving into the technical disclosure of it. The first thing you do is derive income from continuing operations. That is everything up to and including tax expense. So this stuff is going to go into the future. We're not selling off this part of the company. In the Best Buy example, this is all their retail revenues and expenses. Now, after we have tax expense, after we apply tax expense, if we have a discontinued operation, this is when that effect comes into play. We need to separately report two things. One is the income that they got or the loss that they incurred from the discontinued operations, right? So you have to disclose what that is up to the measurement date net of tax. The measurement date would be whatever our reporting date is. So for example, even though they're deciding to discontinue their Geek Squad, until they've sold it, they're still running their Geek Squad. They're still recognizing revenues that come from that division of their company. They're still recognizing expenses that are associated with the Geek Squad division. And so we still report those. It's just now we separate them from the ongoing operations and report them below the line. And then in this amount, you would include any impairment loss on the segment if necessary. And we'll talk more about what impairment loss is, but it'll follow. A gain or loss from disposal, right? This is when we actually sell the discontinued division. When we sell it, we are going to, again, express it net of tax. But the way that we calculate the gain or loss is by taking the sale price, subtracting the net assets, that is the book value of assets less the book value of liabilities, and then also considering any costs to sell, right? Sale price less the book value, less liabilities, less cost to sell. Let's look at the formatting. If we decide to dispose of a component, say that the conditions are met and the sale takes place all within 1 year, that simplifies the reporting. Now, these numbers are assuming a tax rate of 40%. I just put in some numbers. I just pulled them out of the air. No reference to anything here. $1,000, a 40% tax rate on $1,000 would be $400. So we have income from continuing operations of $600. Note this is not net income. If you have a discontinued operation, net income comes after the discontinued effect. You would have a discontinued operations section then. You would have a note. The note would, footnote any disclosures about the company. It would get really specific into the details, what the company, what assets, what liabilities are involved in the discontinued operation, et cetera. And then you have the first line item and the second line item. Note that these are both net of tax. And we'll talk again more about what net of tax means. But we just take a tax effect. There was a loss on the discontinued operation, and that loss is $120 net of tax. And then there was a gain on the disposal, a gain of $30. Well, those net together to give me an overall effect of a loss of $90 from this discontinued operations disclosure, and that gives me net income of $510. So moving to an example with numbers that come in the form of a story problem, which is where people tend to lose it when it comes to accounting. Math plus story problem equals scary stuff for some people. But we really just need to break down all this data into manageable pieces, and I think that's something to always keep in mind whenever you're doing an accounting problem. You can get easily overwhelmed by the numbers. Just take it a piece at a time, take it in a sentence at a time, and figure out what you're looking for and how you're going to do it. So in this case, we have Rocky disposing of Bullwinkle. Rocky's selling Bullwinkle, sold it on November 1st for $1 million. I give you the book value of the assets was $2 million. The book value of its liabilities was $1.2 million. And I also tell you that from the first of the year to the day of sale, the Bullwinkle component had a net loss of $150,000. assume a tax rate of 40% and income from continuing operations after tax is 750. So if we're reporting the disclosure note, we have to start, we have to remember where we start. Income from continuing operations after tax was $750,000. And I'm going to do a lot of abbreviating because otherwise it gets really lengthy. So $750,000, that's income from continuing operations. Next comes our discontinued operations. And remember, the first item is the loss that we recognize. It could be profits, but in this case, it was a net loss of $150,000. So we write loss from discontinued operation, net of tax. Now, this $150,000 isn't the net of tax loss. That would be a pre-tax loss, unless I tell you otherwise. Always assume things are pre-tax unless I tell you otherwise. So in order to figure out what the tax effect of this is, we would take the $150,000 loss and multiply it by 0.4 because that's the tax rate. Well, that gives us a $60,000 tax effect. Now, this might seem counterintuitive, but the $60,000 tax effect would actually reduce the overall loss. Because if we're recognizing a loss, we're not paying money on this $150,000, so we actually get a tax shield from losses. That makes the overall tax effect a $90,000 loss. Okay, so it shields. Now we have to figure out what the gain or loss from disposal is. The first step, of course, is to figure out whether it's a gain or a loss. They sold it on November 1st for $1 million, at which time the book value of the net assets of the assets was $2 million, and its liabilities were $1.2 million. Okay. So we have $1 million coming in, net assets of $800,000, which gives me a $200,000 gain. If this number were negative, it would be a loss, but we got more money than the net assets of this corporation. Therefore, we would record a gain here. So a gain on disposal of the discontinued op, and again, net of tax, is going to be $200,000, but we have to net the tax effect. So in this case, the tax effect is going to be extra taxes because we're recognizing income, we're recognizing a gain. So this extra tax of $80,000 reduces our gain of $120,000. So overall then, the effect of this discontinued operation is $30,000 of positive income. That gives me net income of $780,000. Okay. So again, the tax effects trip people up a lot. One way to remember it is that no matter what, the tax effect reduces losses and reduces gains. Another way of calculating this after-tax number directly is rather than applying the tax rate and then figuring out the tax effect and subtracting that off of the overall, would be just to take the amount of the overall multiplied by 0.6, which is 1 minus the tax rate, which would give you the after-tax amount of the gain or the loss. All right? So we talked a little bit about impairment, and that comes up whenever the entity does not actually get to dispose of the component and the sale is not completed until the following year. So maybe we decided to sell off our component, our discontinued operation, but the operation didn't sell in the first year. In that case, we still own the component at the year end, and we have to do something called checking for impairment. So we check for impairment, and if there is impairment, it's added to the net income or loss from the operations during the year. When do you know you have impairment? Impairment occurs if the fair value of the net assets less the cost to sell is less than the book value of the component. So we have that the book value is greater than the fair value of net assets. Sorry, the book value of net assets as well is greater than the fair value of net assets less cost to sell. If this is greater than that, we have some impairment. The difference between those two amounts is impairment loss. So the idea is that, say this was 100 and say this was 80, just making up numbers. Well, yes, our fair value of this business is less than the book value, less cost to sell. And in order to make it correct, I have to apply $20 of impairment, because that's the difference. That's what will bring my book value down to the fair value of the discontinued operation. Now, if it's the opposite case, if fair value is greater than book value, we cannot record a gain. If the fair value less cost to sell is more than the carrying value, the book value of the component, no gain can be recorded. And again, this is one of those instances of conservatism. Not only are we only going to reduce the book value of my discontinued operations net assets, but also I'm going to try to I'm going to recognize this loss as soon as possible. And you'll see what I mean whenever I work through this next example. So let's look at a different one. Helion decided to dispose of Bacchus, which is a qualifying discontinued component. Bacchus had a pre-tax loss of $40,000 on December 31st. The book value of Bacchus's net assets was $200,000, and the fair value less cost to sell is $130,000. If they are unable to sell Bacchus, record the appropriate disclosure on the income statement that follows, assuming a 40% tax rate, and income from continuing ops is $370,000. So I make you write this income from continuing operations to sort of solidify in your mind what comes before the discontinued segment. That this doesn't just happen in a vacuum, but you need to, especially in this balance sheet chapter, be very aware of where everything is fitting in the income statement. Did I say balance sheet? I meant income statement if I said balance sheet. Really, in every financial statement that we examine, you need to have a good sense of what's above these items, what's below these items in disclosure, because remember, the disclosure matters so much. When we're talking about the disclosure of the balance sheet, it's the disclosure of the liquidity of these items. When we're just talking about the disclosure on the income statement, it's a disclosure related to the persistence of these income items. So we have a loss from operations, has a pre-tax loss of $40,000. And remember, we want the after-tax amount. And so I'm just going to multiply it by 1 minus the tax rate to get what the net of tax would be. See, it's a little bit more direct than taking 40%, which would be 16,000, subtracting 16,000 from 40,000. You're doing the same thing algebraically. It's just a little bit more simple to do it with the after-tax tax rate. Now, we look to see whether impairment is required because they were unable to dispose of Bacchus. So now we have to think about the impairment of the discontinued operation. The book value of net assets is $200,000. So I don't make you, calculate that. I don't give you assets and liabilities. I just give you the book value of net assets. We see if the book value of net assets is greater than the fair value of net assets less cost to sell. Remember, that is the indication of whether we need to impair the discontinued operation. $200,000 is greater than the $130,000 fair value less cost to sell, which implies, yes, we need some impairment. And we need to have it $70,000 impaired because we want to bring this book value down to $130,000. Now that's pre-tax impairment. So we need the net of tax impairment. And that would be $42,000. So now we have two losses net of tax. And we are going to report them on one line item, loss and impairment of our discontinued ops, net of tax. Combine those two numbers, right? That gives you $66,000. That's the overall effect. There's no gain or loss from disposal because it wasn't disposed of in this time period. And then we have net income then. That would be $304,000. Okay. Now we move into the next year. Suppose that Helion had a net loss of operations from Bacchus January 1st to May 17th of $8,000. On May 17th, we sold Bacchus. We need to now complete the discontinued operations, assuming some income and a 40% tax rate. Well, again, income from continuing operations. This guy I get more and more abbreviated the more I write this stuff, and that's okay as long as you know what you're abbreviating. That's the privilege of abbreviating. Only comes when you know what you're abbreviating. Now, let's see, what else do we have here? We have a loss on operations. We don't have impairment this time because we sold it. So loss from discontinued ops, net of tax. That would be 8,000 times 0.6, which would be a $4,800 loss. Didn't do K here, so I'll just keep consistent here, $4,800 of a loss after taxes. And then we look at the gain or loss from disposal. Now, when you've impaired something, it is very important to remember that once you impair the book value, that is its new book value of net assets. So in the prior year, we impaired it down to $130,000. So now we have a sale price of $150,000. We're subtracting off the book value, which we impaired to $130,000. And we actually recognize a $20,000 gain. Be careful, because if you use the old book value of net assets, you would record a loss, which is incorrect. A gain from disposal, net of tax is $20,000. So the $20,000 then would be, I just made a huge mistake, right? I didn't take taxes. That is not net of tax, that's pre-tax. Be careful. We all make mistakes. Just make sure you catch them before you submit your test. Right? So now we aggregate this tax effect, and we come out with a $7,200 positive effect from this discontinued operations disclosure, which makes my net income then $397,200. Just so you know what's going on with that impairment disclosure, what the journal entry is, and I won't test you on this, but just so you know, and I'm going to simplify it greatly. We'll look at this in more detail in Intermediate 2. But in the impairment that we applied last year, we applied a $70,000 impairment. It would be an impairment loss of $70,000. And, for the sake of brevity, we'll just say that we credited the net assets by $70K. So we reduced the net assets of the discontinued division by $70K. And that's why it sticks around to the next year. This gets closed out like any other gain or loss, but this net assets is a real account of our discontinued operations, and it sticks around. And it went from $200,000 down to 130 because of this credit. Okay. So what would have happened if we didn't apply any impairment? Now, this is the question that sort of shows you how conservative this treatment really is. If we hadn't applied any impairment, then if you look back at the entry we made last year, the only thing we would have recorded, because 42,000 of the 66 was the impairment, we would only record a loss of 24,000 here. So from 2016, I'm looking at the overall picture. From 2016, we would record the $24,000 loss. And then in 2017, when we actually sold it, we would record, of course, this $4,800 of a loss. And, sorry, this is in 2017. We would record the gain or loss from disposal. But since we didn't impair then, the gain or loss from disposal would have been $200,000 of book value, $150,000 of sale price, which would result in a $50,000 loss on sale without impairment. Okay. Now, again, take the after-tax tax rate on that. It's a $30,000 loss. So overall then, what would we have recorded? We would have recorded $58,800 of total loss on discontinued operations. That's their total effect, right? Well, what did we record? We recorded, if you recall, the $66,000 of a loss, and then a $7,200 gain, which comes out to exactly the same loss. Right? So these are the same. This is without applying impairment. This is with applying impairment. So what makes one more desirable than the other? Well, again, it's conservatism. Not only do we want to choose to report our discontinued operation at the lesser value of net assets because of the impairment, but we also want to record the loss sooner. As soon as we know it, we record that loss. And that's an aspect of conservatism as well. All right. So anyway, that is that for discontinued operations. This is all you have to watch up into our class on Tuesday. And I hope everything makes sense. If you have any questions, please don't hesitate to email me and let's talk them through. Thank you.